Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. My guest today is Kent Ritter, the CEO and founder of Hudson Investing, where they allow you to gain control of your financial future with low-risk real estate investments. That's multifamily, but Kent learned by investing in 10 multifamily syndications before he started syndicating himself in 2019 with a 250 unit. Let's get into it. This is episode 275 of Zen and the Art of Real Estate Investing with my guest, Kent Ritter. Kent is the Chief Executive Officer and founder of Hudson Investing, a multifamily real estate syndication firm. They acquire, manage multifamily real estate investments, you guessed it, helping investors build wealth through strategic property acquisitions. Kent is also the owner of Hudson Capital. Kent, welcome to the show.
Thanks, Jonathan. Appreciate you having me on today.
Yeah, excited to talk to you. And I'm always excited to talk multifamily. And I always tell all the multifamily syndicators and investors that I do a lot of multifamily shows, but it's still interesting to me how they're always different. What do you find most interesting about multifamily real estate investing in the syndication world?
Yeah, that's a really good question. I think it evolves all the time. I mean, one thing I love about real estate is there's just so many aspects to it and so many ways to constantly be improving your craft and things that you focus on, whether it's combating, operating expenses or interest rate moves or, whatever it is in that certain day. But I would say interesting for me right now, it has been deeply diving into property management because we just brought all of our property management in-house. So we went from, having third parties manage for us and through about a 10-month effort, brought our entire portfolio in-house. So it's been just really gratifying, really educational. It's always cool for me now where I am in the business to be able to be kind of the strategic leader, but bring in subject matter experts into these different verticals, which is what we did for a property management company. We brought in folks with 30 plus years of experience to lead the firm and then just really build a team around them where I'm able to kind of take my strategic mindset, my years of management consulting background and just challenge folks with great experience to think a little bit differently and just see that unfold. And it came together in an amazing way for this new property management company. So that's what's most interesting to me right now, because when you think about what I've learned over my 10 plus years of real estate investing is nothing drives performance or can make or break a deal more than the boots on the ground property management and the people that are day-to-day interacting with your clients, right? Your residents. And so just taking a deep dive into that, learning a ton and building that out is really what's interesting to me right now.
Yeah, and bringing it in-house even gets you closer to the answers that you were saying are so important that you could still miss if it's outside property management. What was the main reason? Did you get up to a unit count where it was hey, this is just going to make sense, we're ready to take this over? Or was it a philosophical thing, it's time to just do this all ourselves?
It was, I wouldn't say as much a philosophical thing as very much a practical thing of I got tired of beating my head against the wall, frustrated about if I looked at what I spent my day on, and my asset manager, my VP of asset management spent her day on, we did the math that 60% of it was spent in what I would call babysitting, right? Which is non-value, not that it's not value add, but it's not value add from my skill set or her skill set, right? It's just making sure that people below us are doing what they said they were going to do.
Yeah.
and that became like, we really did a time study with her, and 60% of her week was spent in those tasks, not value creation and strategic thinking, but just, hey, you said you're going to do this. Did you do this? Right. And so I just got so sick of that. And we said, if I'm going to be frustrated all the time, I would rather be focused on the positive kind of friction of building a new business where we can control the outcome versus just being frustrated, trying to cajole and convince and get these people to do just what basic property management services. Right. And, and I've worked with a lot of different property management companies, and I'm sure there's some great ones out there. I've had varying levels of experience, but like at the end of the day, the analogy I use is like, nobody's going to love your baby as much as you love your baby, right?
Yeah.
The babysitter doesn't love your baby as much as you love your baby. And that's how it is for me on these properties.
Yeah.
And I just had been, the philosophical piece is I've been so proud of the culture we've built at Hudson Investing, but we couldn't bring that culture down to the ground level to our residents because we had this gap, right? Where we had this third party coming in with their own culture and their own way of doing things. And I was just never happy with it. And so that's really what it was. I would say the other really practical piece, because I always had this vision, even coming from the larger PE firm that I came from, where you get a certain number of units and then it makes sense from scale to bring property manager in-house.
Yeah.
Well, that to me, that was always 2,500 units to 5,000 based on who you talk to. We did it with about 1,200 because earlier on the curve than I wanted to, but it was just a situation where there was a couple events that happened where some good people became available. And, I feel like the universe gives you things, not necessarily on your timeline, but but when you need them, and you need to pay attention to those things. And so I've always tried to take advantage of those opportunities. And so these good people, these good property manager people came available. And then we were able to just grab some great folks to really build a company around and just build it out from there. And so the timing was just there. It wasn't necessarily my timeline, but it was the right time. And so one thing as an entrepreneur, right, you just have to be nimble and be able to make quick decisions and be decisive. And so I felt like we did. And we just kind of last October decided to set a goal to go live mid this year. And we hit it July 1st.
Yeah, the culture thing really stood out to me because it's a different buy-in when you have outside property managers. They could be the best in the game, but they, as you were saying with the baby analogy, like they own their own business. So their job is to make that business run well, which of course means servicing their clients well. Still not the same buy-in as putting it all under one roof and saying, hey, if things aren't going well, I don't need to wait to track down someone and talk to their assistant, in the different state. I'm just going to go downstairs or go through a Slack channel or go through workflows here.
Yeah, absolutely. And the other thing that's really been eye-opening for me is now that we have, all the systems are our own, right? And we're not relying on access into someone else's system. And it's always varying degrees of access. What will they let you see? What will they not let you see, right? You're always waiting till, 15 to probably more like 20 days after the end of the month to see the financials. And I always just felt like we were making decisions off of old information, and we layered tools on, visualization tools and things. And we did have direct feeds into the property management systems to try to get more current information. We had built kind of a good workaround, but there's nothing like just having your own system and having your own access and being able to look in there every day and be able to pick up on trends early versus making a decision on something that happened 45 days ago.
Yeah, and like you were saying with the culture, that can save you a ton in the long term because you're catching stuff and then you're more direct with the residents, which makes for a better property overall. Maybe it doesn't necessarily raise property values in and of itself, but it raises the happiness factor of being there, which eventually will make rents go up if it's more desirable than other ones that don't have good management.
And just reducing turnover, right? It's just giving people a good experience, doing what you say you're going to do. I mean, the biggest expenses that we'll have are going to be turnover costs, right? If we can avoid that turnover and we can keep residents there and increase that rate of renewal, it's accretive to the investment, which is the whole goal. And philosophically, as you said, it's like a third-party management company is focused on their own margin. They have to create a margin to have an ongoing business, right? The only reason we're doing it I don't care about margin in property management. The only reason I'm doing it is to improve property performance. So it's just a completely different philosophy in approaching it. So anyway, it's been just an exciting endeavor. And even when we look at like payroll costs, like what was cool is our payroll costs across, like on a monthly basis across our portfolio, we're saving like $7,500 a month on the portfolio just in payroll costs, in how we're just doing it in a different way. And so there are true immediate savings coming back to the properties as well, which is fun to see.
Yeah. And the last thing on the property management, most interesting thing to me is talking to so many other syndicators and people who've done this, and you're backing it up again. It's not that you make a bunch of money off property management. It's that you just make the experience all that much better. And like you said, you're going to save a little bit here and there by bringing everything closer together. But I think a lot of people think, oh, like, look, nice side business, you're going to crush on that. Like, it's not about that. It's just about vertically integrating and making everything smoother, right?
That's 100% right. You shouldn't go into property management if you're trying to have a high margin business. It's all about control. It's all about control and being able to do the best thing for the assets. Yeah, that's absolutely right.
Yeah. So I know you graduated with finance and economics degree. Did you think you were going to go into real estate when you got out of college, or how did real estate start peeking its head in?
No, it was nowhere near my radar. So I went into management consulting at a school and went into really I went into the financial arm of the management consulting firm at a school. Well, that was 2007, right? And then 2008, GFC, the financial practice folded, just went away. And they were like, well, you're a new analyst. You've done well. You want to go to healthcare because that's growing. And I was like, sure, because I want a job, And so I actually spent the first really 12 years of my career doing management consulting in the healthcare space. So completely different. Yeah. On that path, I started a business in healthcare management consulting. We started our own boutique firm. The reason I say all this is because fast forward to 2015, we sold that business, had a big capital event. Prior to preparing for that, I started asking the people around me who I thought were older and wiser, what do I do to deploy this capital? And everybody said, invest in real estate. So that's how I got into real estate. It was really about, and it's my economic investment mind, right? I want to diversify, right? Don't all my eggs in one basket. And I wanted something that was uncorrelated to everything else I had, which was in the stock market. Yeah. And so that was why I started. And I started investing passively most of my money with other syndicators and people. And then I took some and I started doing single family house flipping with some buddies from college. And so, kind of learned that game. I've done about every strategy under the sun if we fast forward, 10 years, but really landed through all that experience that multifamily was the right asset class and that these syndications was the right model to really grow the business on. And like in 2019, focused everything on just doing that. So kind of brought all the strategies together, sold off all the old stuff and just said, this is the path forward for me in 2019 till today.
Yeah, it's interesting that you started investing as an LP in syndications, because I personally think this is going to become much, much more interesting to younger high earners who probably aren't going to buy a home because it doesn't make sense. Maybe they're going to rent in a nice city, but they have deployable capital like you did. Like, what are you going to do with it? And I don't think it was something, if you go online, of course, social media is insane, but there's not a ton of people saying, hey, you new people, you should think about syndications. There's syndicators pitching their thing, but everybody's talking about, what looks more flashy, house flipping, things where you can lose a lot more money. Do you think that this is going to take hold for these younger people who are making money and like they're not going to sink it into a house and they might want to sink it into a syndication if they're accredited and earning a lot?
I hope so, because, I would say, look, I'm happy for all the experiences I've had, right? But, the whole journey I went on of single family house flipping and owning single family rentals and self-managing and all that. I wish I would have spent all that brain damage just focusing on multifamily and on syndication. Because I learned a lot, but you take a lot of lumps, and that is a very risky strategy. Like house flipping, especially because even today, this was 10 plus years ago, the margins were better.
Yeah.
Right?
Oh yeah. Yeah.
And if you don't think flipping is an absolute 80-hour plus a week job, then you haven't done it.
I agree.
And then managing a bunch of single family rentals is also, you get to a certain amount where your phone's there's always an issue just because you've got so many of them.
Yeah.
And so for all those reasons, like I try to tell people, because I have people coming to me all the time. Maybe they're listening to my podcast or I just meet them and they hear what I do and they say, hey, I'm thinking about buying a duplex, or I'm thinking about buying a quad or this. And I'm always like, look, it's not as easy as you think it's going to be. It's way harder, actually.
Yeah.
And what do you do now? Okay, you're a high earner. How many years have you spent doing that? Okay, you spent 15 years learning your craft, right? You're in your peak earning years. Well, why are you going to go buy yourself another job?
Exactly.
Right? Focus, because that's what you're doing. If you're buying a single family or any type of rental, you're buying yourself another job. How much time do you have to commit to that? Do you want to? Do you want to be doing that after hours because you're working full time? And I'm like, look, you've spent forever focused on what you're great at. Go earn as much as you can doing what you're great at, right? You're not as passionate in real estate as I am, because the thing that I didn't expect was I fell in love with real estate and like went all in. That was not my original plan, but I just love it. I love the deals. I love all that. Like, you're not investing as much money in it or as much time in it as I am. You don't have the team of 30 plus year experts that I have. And so like, let me focus on your real estate and just send you a check. Right? That's the whole model, right? You make the most money over here. You deploy some of that with me to be well diversified. I don't want all your money, right? And then let me get as much out of that as I can, and you don't have to think about it again. And that I think is the best model for everybody to be successful.
Yeah, and I think it even starts, so if you go back to house flipping, a lot of people in the beginning, they want to DIY it, and then they realize, well, I don't know what I'm doing. I'm screwing everything up. So then they hire a bad contractor. Bad contractor's better than them, but also sucks and steals money. Then they get a good, reliable contractor, and they pay more, but they're like, oh, that was going a little better. Yeah. But in general, flipping still is annoying. But then they realize like, oh, wait, I'm going to keep going up and it's becoming more and more passive. But I think people don't understand that there's really very little in real estate that's truly passive. And being an LP is because you can't have any control. That's the point. Yeah. And to me, that's helped me understand to release a little bit of control. And as you were saying, hey, why don't I trust someone who all they do all day is multifamily, and I don't want to do that?
That's right. That's right. You got to align yourself with your passion, right? I mean, that's how you're going to get the most out of anything. I also think that especially newer investors undervalue the impact of taxes, right? That's the other thing about house flipping, anything short term, right? Is you're paying ordinary income tax versus being able to pay capital gains and even be able to just unique strategies, even defer those tax payments. It's like, it's way easier to keep what you've already made and earned than to go out and earn more, right? Yeah. So like maximize what you're keeping in your pocket and not paying out in taxes through good strategies. And I think that's something that a lot of newer investors, and I didn't really understand for several years until I really started getting deep into it, how you really can play that game and really create a ton of value for yourself.
Yeah. And as you were saying before, you're going to loosen up a lot of time by trusting other people to handle the stuff. Same as, in the financial industry, do you want to sit and do your stocks all day and become like a modified day trader? You'll literally spend all day. You probably get most of it wrong. Or do you just want to hire an expert, or just want to dunk the money into index funds and be like, hey, I'm just going to leave it there. I know it's going to go well. That's how I look at syndication investing now. For me, I know that I've already vetted the operator and I'm trusting the money to ride. I can't get it back. I got to wait for it to go full cycle. I'm going to get distributions, but I can also watch along the way and feel like, hey, I'm a participant in multifamily without being an active operator in multifamily.
I mean, I think that's really well said, Jonathan. Yeah, absolutely right.
Yeah. So who's your avatar, though, for people who want to invest with you? Because it's always interesting to me who wants to get in or where you started. Once you got this going, who did you start with? Because, of course, you're like, I need all the money to get this going. But then as you go later on, it becomes a little bit more discerning as who's a good fit for being an LP for these particular projects. Yeah,
it's a good question. When it starts, before you have a track record, the only people that are going to invest with you are the people that are investing in you not in what you've done, right? And so it's going to be your friends and family. And that's exactly how I started. My very first investors were my closest friends and family. And because of that, it was very personal for me, and still is, because a lot of them are still investing and now rolling forward in multiple deals. But I mean, that's how it's just very personal, right? Because it could be an awkward Thanksgiving if things don't go the right way.
Yeah, right.
So that's how it started. And now we're probably on, in some ways, 6 to 7 degrees of separation, but we still, my favorite place to get new investors are, through referrals, right? And have people who can tell their story, because you just know that the people coming in are also going to be good people, because it is a two-way street. And when you start out, it's really difficult to say no to capital, right? Yeah. But there are some people that are just a bigger headache than their dollar amount is worth, you know? And there's been folks that we've said, you know what, this is not a good fit for whatever reason. And so that's one of the good things about being an entrepreneur, is you can be kind of selective, but the hurdle's not high. It's just be a good person who treats people well, and has some level of realistic understanding, right? And you'll make it, like you'll be in, just be a nice person. The more specific avatar, I mean, I would say, look, we want everyone to come in. So there's no limits. I would say one of the only limits is you have to be an accredited investor, and so there's certain hurdles you have to hit from an income or net worth standpoint. But after that, I mean, the more the merrier. We have investors who are, very young, 20s, early 30s, and have had early success, the folks you described, right? And are looking and are just smarter than I was at those ages, and are saying, how do we deploy this capital? How do we not just like go to the bars and go on trips and things, which I think is great of that generation, to folks that are retired, and all, they want steady cash flow, right? But they're retired, but they also recognize, hey, we're probably the 401k game isn't all that there is. We're probably going to live longer, and we want to make sure that we maintain our nest egg, and we still need some upside as well. But anybody in between there, right? But a lot of our people are entrepreneurs themselves, or they're, we have doctors, attorneys, professionals in some way. A lot of folks that just think outside the box, right? And have taken the time to learn about this other type of investing. Because like you said, it's not in the mainstream media like, index funds and things are, and 401ks and, Fisher Investments or whatever the commercials I see, right? Yeah. And so you have to do some work yourself, but like the people that listen to your podcast are doing that work. And so it's a lot of people that come in from podcasts like this, from my own podcast. That's where we get a lot of people, but it's cool because we've really tried to create a community of folks with aligned interest. And within that community, we try to create some like circles of value and kind of this flywheel effect where if we're hosting events and we're introducing each other, or there's been cool things where like we've been able to buy services from some of our investors, whether it's maintenance uniforms, which we just bought from one of our investors' companies, or, different things like that. It's cool to see like these virtuous cycles create themselves among the community.
Yeah, and I think that kind of is like a sidecar to what I look at as masterminds. A lot of people, when they are new, they're thinking, hey, should I get into a mastermind? And they're thinking about the content that they're going to get in the mastermind. And we both know that it's about the group in the mastermind. The content's pretty much all the same in every mastermind. It's just like, who are you aligned with? Who also has the buy-in? And that's why I think it's very relevant to the groups of investors that you have, because they all have generally the same buy-in. It may not be the same. Someone may be 50 grand, another one may be $1 million in, but they're all buying into the same thing, that passive income, multifamily, and they're riding in the boat together. So it does give them a good like camaraderie to say like, hey, like I have friends who I'm in deals with who I said, hey, come into this deal. Like I've already done one with them. This is going great. Look at this. And now we can talk about it. And it's fun, especially as I'm getting older, but I can see it being even fun for the young ones who are investing too. Because instead of just looking on E-Trade or checking your stocks on Fidelity, like you can just look up the asset on Google Maps, if you haven't gone, and you say, wow, like this really is a nice building. This is someplace that I would live, or this is a place where I want my kids to live. And then, you own a small part of that. And I think that becomes a little bit more exciting than some of the other stuff, and diversified, like you said earlier.
Yeah, I totally agree. I mean, I think all of us are looking for these communities of like-minded people like to be involved with, right? And, I think as you reach certain levels of success too, the people that kind of are at that same level or maybe share the same values can become thinner and thinner or more widely distributed, And so I think it is cool in that one thing we've been able to do is build a community of these really like-minded people and bring people together from all over the country and even a couple other countries to, but all have a lot of the same shared values, and the same commitment to their financial future where they've done the work, to recognize these investments and get in there. And so, and a lot of them are really high performers in their own right. So I learned a ton from our investors. Like I've got investors that are really savvy tax people, investors that are really savvy, like interest rate and derivative people. Like I've learned marketing folks, it's cool. Like when you just being able to interact like that is really what energizes me, is being able to meet these people and interact with them and hear their stories and give some value to them and just exchange ideas and learn things.
Yeah. I mean, that's really the goal for everything. Hey, it's Jonathan. I hope you're enjoying this episode with Kent Ritter as we talk multifamily. But where Kent started, where I started, where everybody started is usually at the beginning of the journey. I was a little bit luckier because my dad was just throwing real estate at me all the time. But now, one of the best ways to get involved in real estate and start to build your confidence is through real estate investing meetups. There's a lot of ways to find them. You can go in the forums at BiggerPockets and look in the events. If you're in New Jersey, you can come to our events. Go to zenandtheartofrealestateinvesting.com, click the events tab, and you'll see that we hold real estate investor meetups on the first Wednesday of every month. No fail. Hope to see you there. Let's get back to Kent. I wanted to get into your geography choices and your unit count choices. In terms of those, where did you start and where are you focused now in terms of geography? And then we'll get to, what unit count is attractive to you, because it's really different for all operators in terms of what they're looking to buy.
Sure. Yeah. So geography, again, started very practically. I live in Indianapolis. And so we started in Indianapolis.
Yeah.
And so that was really the focus. I did invest some in the Southeast just through some partnerships and through other folks I had met where they were boots on the ground as I was getting started. But as we really brought Hudson Investing together, it was, let's focus on core Midwest. So most of our properties are in Indiana, Ohio, and Kentucky. And we've got, we did do some, we were looking more in the Southeast, as everyone was over the past 5 years. And we have an asset in South Carolina that's doing well. But really, as we decided with the management shift especially, and just everything that's happening in market dynamics, the Midwest is really on the upswing. The West, Southeast, because of oversupply in many markets, have been kind of down. And so we said, wow, well, we've got these great market fundamentals in our backyard. So let's really hone in on the Midwest. And so that we started here, we went out, and now we're kind of back.
Yeah.
So that's how it's evolved over time.
Yeah, it makes sense. And then in terms of the unit counts, are you looking for above a certain number or under a certain number? And that really, I guess, depends on how long you're going to hold, who your intended sale partner is later, and what the plans are for each deal.
Yeah, I would say in broad strokes, the space that we play, we like to be one of the biggest fish in a smaller pond. And what I mean is we focus on 100 to 250 unit properties because 250 and above is where you start to run into like the firm I used to work at and the other firms out there that have 30,000 units and the REITs and everyone else. Right. And so that 100 to 250 space has been just, I think, a great space for us where we've been able to have enough scale, but also still find good deals and some good value add opportunities. Now we have properties that are 80, 70, and then even some properties I bought early on that are smaller, that are legacy deals, but we won't shy away from 84 townhouses like we bought last year. It's a different kind of asset, more of a BTR, but largely that 100 to 250 unit from like a price standpoint.
Yeah, and in terms of like what people will grade, I mean, I always think that the property letter grades are, subjective, but what are you looking for? A, B? I mean, it's so hard because now everything that's getting built, of course, is A. So there's a lot of money in the
Right.
B, but it's like, is it a B going to B minus or a B going to B plus? Where are you guys looking for those type
Yeah,
of assets and what types of neighborhoods?
for sure. I mean, there's a couple of strategies there that we've had success in, right? So we like the C, that we can make a C plus,
Mm,
or even move into a B, right? I mean, it is all subjective, but a
yeah,
solid C workforce. Like we've got a deal right now we're working on in Fort Wayne, Indiana. It's a solid C workforce property
yeah,
built in the 70s, and a lot of it is still original 70s, like cabinets, yellow appliances, like real
yeah,
original,
yeah,
where we know we're going to be able to come in and we're going to be able to renovate those units and turn that into just a safer, cleaner, more modern, still workforce property for
yeah,
folks that are those blue collar residents who are going to be great long-term renters for us,
yeah,
right? And so I love that strategy. There's a lot of safety in that strategy, because we're able to maintain like 50th percentile market rents.
yeah,
We've also had a lot of success on the other end of the curve on the A strategy of, like I mentioned, the townhouses we bought last year in one of the highest growth submarkets in Indianapolis, brand new townhouses. We got a value because we bought them at a lease up. So the
mm,
developer, they're about 65% occupied or so. We knew it was a great area. We knew that we could get that leased up. And
yeah,
so, we got a good value because we bought it with some, we took on that lease up risk
yeah.
and we got it full. It's 95% occupied now. And it's great because we're just moving with the momentum of the market in a brand new asset. So different strategies, both in the right submarkets and markets can be successful.
Yeah. But I mean, even more important to bring the management in house because those are two different styles of management that everyone has to get comfortable with. C plus to hopefully
Yeah.
C, maybe B minus is going to be renovate, move some people around while you're renovating, deal with some bit of roll off for people who are like, well, I don't want to pay more, even if I get a nicer unit. But I found overall, and I
Yeah.
wonder if you did, that for workforce housing, those people are very steady income. So when they're going to end up paying more rent, but they're going to get a much better product, they're like, yeah, this is great. It's just that they were okay living there because they're so busy working that they're like, I can live with this.
Yeah.
But if you give them the opportunity to pay up, they not only can pay up, they're going to really enjoy that new place because it's just going to be a better place to live. Like you said, safer, cleaner, more accessible.
Yeah, that's right. And one thing that we look at in every investment, we look very closely at the incomes, both in the area, but then on site, on the property during due diligence. And we're always looking at, that kind of 3x relationship between their income and what they're paying in rent,
Yeah.
right? Because that's really that affordability mark. And so we watch that very closely. And as we even look at what we think we can raise rents to as we spend, $16,000, $17,000 renovating a unit, is that going to be out of reach of the folks that currently live there?
Yeah.
And just managing that. So we look very closely at incomes and rents, both before and after renovation, as we make any of those investments for that reason. But yeah, I mean, I found generally that if you provide value, if you do a good renovation, if you're not just raising rent to raise rent, but you're giving people back something for it, that a lot of people will appreciate that and will stay on board.
Yeah, because you can make a big mistake in a C. You can really give it a B renovation and want the B prices, and you're not getting the B prices because
Yeah.
you're not B. And I think I've seen people do that. Maybe they started off on the wrong foot, and then they're not only have vacancy. Now they don't know what to do because the numbers aren't going to match. So the investors are looking at it like, wow, you can't even hit your rent projections now, and your occupancy rate is going down. So it is really important, as you were saying, to know what the income generation is there, what the spread looks like for them, so that when you provide it, but there's always going to be some turnover. But I think everybody in general, even down to D market, they want a better product. It just has to match what their income profile is.
That's right. You gotta be able to really add value for it. And yeah, I think that's one of the biggest mistakes investors make is overspending. And I think through experience, the ability to really separate yourself from the renovation, because you
Yeah.
can say, oh, I really like that backsplash. It's like, well, you may like it, but it's not in the budget, right?
Yeah. Yeah.
And so really looking at what we look at is return on cost for construction. And we're looking for that to be in kind of the 15 to 20% range. And meaning the rent premium we're getting relative to the cost. And so that is really a metric that allows us to very objectively control what we're spending and not get overly excited about finishes and things. And so I think in that way, we're able to control that. Like I said, the property we're acquiring in Fort Wayne, the thing I've told the team is that, look, the worst thing we can do here is overspend. So we need to be very mindful on what we can keep and save and is still in good quality, and we need to fix around that. But the last thing we want to do is price these people out of where they're living.
Yeah, it messes up the community. It was funny though. If you go back to both of our flipping days, that's when you can make a excited tile choice then, because it's just one bathroom. Like, okay, you spend $400 extra bucks on a bathroom. Maybe you didn't get the ROI that you wanted out of it, but if you make that across 100 units, you're in trouble.
That's right.
You got to relax.
Yeah, or 209. Yeah, and so you just have to understand what really creates value. What creates value and what is just kind of aesthetics, right? And I think that just comes through experience. And so, at this point, we've got it dialed in. Like, we know, we basically have 3 renovation tiers. We got a C tier, a B tier, and an A tier. And we know the products to the specific items, what they cost, what the package is, and we know what's worked well from, paint colors, floor colors, different fixture. We've done the research through what's worked and what hasn't in real life. And so we've been able to really dial that in.
Yeah, you're creating a new canvas for someone that's basically not offensive to anybody for renting. You just say you can't have 7 accent walls. Sure, you can throw one in here and there, but generally you just want to make it so nobody has an objection when they come in. Maybe they're not like, this is the greatest place that I've ever seen in my life. It's not flashy, but it's like, wow, this feels great. And I can add my own touches, which is, I think, what most people want in any home, whether they're renting or buying.
That's right. I think we look for kind of a classic style with a little modern twist, and very, very neutral, right? Appealing to all. And I think we've, and then I think something I've learned over time is, if you're going to spend money on the things that people touch and interact with every day.
Yeah.
Those are like doorknobs, cabinet pulls, faucets, thermostats that don't break.
Yeah.
Nobody's happy if it's 95 degrees in their apartment. But if you think about, just even subconsciously the signals that you're receiving, if you're touching a door, oh, this feels chintzy, or, your faucet, oh, this thing kind of jiggles and doesn't feel quality. I think those things that you touch and feel every day are things that give those quality signals. And things those are areas where I will pay up on, like a nice faucet is a centerpiece that just is going to last long and feels like it's high quality.
Yeah, that's great advice. That's great advice to baby flippers also, because it's like, they spend a lot on these other choices and on the actual construction. And then they're like, oh, well, what do door handles matter? That, like you said, you're touching them all the time.
But if you got something that jiggles and is light, just doesn't feel good, it just subconsciously sends signals as well.
Yeah. And again, so if you put a new tenant in and you have a problem, that's going to sour them the whole time. They're going to become a problem client, and you're going to think it's them. And a lot of times it's the landlord, because they left some things undone. And I think that's where everybody as an operator needs to understand, and actually that was our bad. That wasn't a good product. We can't hold that against them, but you can create a thing, don't you think, where now this person's going to think everything's wrong. They're going to call more because they started on the wrong foot with something that you could have just chose a better product for 11 cents more.
Yeah, for sure. And, we talked about how I was in management consulting for a little bit, in healthcare, right? And one of the things I saw when I was in that space, you saw this with hospitals, as all these I never worked on the expense side, so I could talk, but as consultants came in to focus on expenses, I mean, if you've ever been in a hospital or a doctor's office these days, like the gowns they give you, they're rough, paper thin, the sheets they give you, the blankets that are like this tiny little thing. Those were all decisions that looked great on paper, but do not provide satisfaction in real life, right?
Yeah.
But it's, we could save a few cents here and we're buying 1 million of them. And so that seems like a good idea.
Yeah.
But, it's just the experience is bad now. And so that's what you're trying to avoid.
Yeah. I mean, I think everybody can take a note from that, especially when you think about, if you think about it from the hospital setting, not only are you getting like the worst product, they're charging you the most for it. And that's the last thing you want to feel when you're going into a new rental. You're like, oh, well, the price is high. It looks great in the pictures. And then you get there and it doesn't look good in person, because there's a real wow effect when you finish the renovation, especially if you just say that Fort Wayne property, when you go from a C to something that looks like an A, but it's still in a C area. But wow, the difference when the residents see that is going to be dramatic from the way that it was being managed before to the way it's being managed now with new management and new owners.
Absolutely right. And to a point you made earlier, like the first impression is so important. And so when you think about a couple things, you think about like the clubhouse.
Yeah.
Right.
Yeah.
As the first impression when people come in, it's got to be immaculate. My rule of thumb is like, let's go a level up. If it's a C, let's do a B, A, right on the clubhouse to give people that great first impression, even the drive up to the clubhouse, the flowers, the landscaping, all of that. But also something that you said, which I kind of chuckled about, because we've definitely been caught in this before and learned our lesson, is making sure the pictures are not so good that they don't relate to the real thing, right? Because you can do a lot with virtual staging and stuff now, and you can take pictures from a good angle, but you're setting up people's expectations. And I found it's better to be realistic and to manage their expectation. When they show up, they're like, yeah, this is what the picture looked like, what I thought I was getting, not, oh, I thought it was going to look better. That's never what you want when people show up for a tour.
Yeah. I think virtual staging is one of the worst things to happen to, especially real estate agents, but even for developments, because if you expect it to be furnished and you show up and it's not, it just feels like something's wrong. Especially for those of us who've looked at like REOs and stuff, you're like, ugh, it just doesn't feel good. And even if it's nice, but it's still, everything feels bigger with furniture in it to me. So if you have people are having model units, like you can show one that's full and one that's not, but to have nothing and then have only virtual staging, it's like a trick. And it doesn't feel as good when you show up and that TV is not there. It's just like a floor and the floor is dusty too. It's just a bad experience.
Yeah, it is interesting that everything does look bigger with furniture in it.
It's crazy.
I've also learned through development that everything looks bigger once you put the drywall up than when it's framed. I'm like, man, this is going to be small. But it is funny, that trick.
Yeah, people really should know that, though. I was getting my daughter her first apartment, as an adult, and it was so small. It was so cute, but so small. And then I came back. She's like waiting until she had it all set up. And then she's like, okay, come back. It's furnished. I walked in. I'm like, what? The place looks 5 times bigger with furniture. And so, but that goes to what people feel when they're coming in, and especially for residents, if they're doing that, you're doing a changeover, you can show them the new thing. Hey, do you want to upgrade to the new units? It just feels better. You don't have to stage, 20 units, all the models. But that goes back to just, model home building. And probably what you have in the townhouse development is a lot of those places when they're built, there's always a model unit with the customizations. I remember when I started investing in Florida, I would go and there'd be like, 5 models. It's kind of fun at the time. See them all furnished, all the different styles, and choose from them. I think that's what gets people excited.
Yeah, leasing is sales at the end of the day, and it's all just getting people excited about it and giving them a great product, and and then you follow through with what you say you're going to do, and you'll have a happy resident experience.
Yeah, and don't you had mentioned the curb appeal even going up to the clubhouse, but I've always said that the exterior is an indication of what's going on the interior. So for landlords or large scale multi-operators, if it looks bad when you come in, it's going to be a problem. It just means that management's off. Like if I'm driving with one of my kids and looking for a place, and then, there's weeds growing everywhere, I know that they're not the stove goes out. No one's responding. It's just obvious.
That's right. That's right. Yeah. It's so a great lesson I was taught by one of my mentors in the multifamily space who has, I don't know, 30,000 something units now, was that, what they learned and what they saw from people is that, most people spend too much on the interior and skimp on the exterior.
Yeah.
And so they really took a strategic shift to flip that, and really focus more on the exteriors. Make the interiors nice, but really put a focus on making the exteriors nice, the amenities nice, for all of those reasons.
Well, I think if you come home and you pull up, whether you live in a house, condo, townhouse, development, and the exterior is dirty, you're just not going to take care of the inside as much. You may try harder, but it's just like almost deflating to come home to something. Sure, apartments look different than a single family house. But again, I was just looking with my daughter for a new place yesterday, and we went to like a traditional kind of garden level complex, 2 levels. There's probably, 40 units, nice. It was like very well maintained, manicured. And I was explaining to her, hey, this probably means that the management is good. I mean, like if the upkeep here is good, the laundry rooms are going to be good. There's not going to be issues. And I do think you're right. I think a lot of people are thinking like, hey, well, the pictures of the interiors are going to look good, and that's what renters care about. But it's not. It's still their home, and the outside's part of their home.
Yeah, and that comes full circle to having management in-house and having the ability to really drive more of the control of that. Because, there's nothing that I hate more than driving up to one of my properties and seeing weeds. It drives me nuts. Weeds and trash drives me nuts. And that it just kept happening, and I said, okay, that was one of the big things, honestly. I'm like, we gotta make this switch for everything you said. Well, if they're not even doing this, what else aren't they addressing? And so now just being able to have control over that has been great. Yeah.
Awesome. Kent, where is the best place for people to get in touch with you guys? Is it at HudsonInvesting.com?
Yeah, HudsonInvesting.com is a great place to reach out, to get on our weekly newsletter we send out. If you're kind of just interested, if you're committed to investing, you can set up a call. And, we're happy to get on the phone with you for 15 minutes to an hour and just understand, kind of where you are, help you with strategies. Never a hard sell. It's always about education first, so you don't have to worry about that. But that's a great place to reach us. And then, other than that, LinkedIn, I'm just Kent Ritter. I'm easy to find. It's a great way to reach out as well.
Yeah. And what about your podcast? It's called Ritter on Real Estate. Am I right?
Yeah, I guess I should really plug that, huh? Come on, Kent.
Yeah, we're on a podcast.
Yeah, it's called Ritter on Real Estate. That's right. It's called Ritter on Real Estate. Really similar. I spend a lot of time talking about multifamily, a lot of time talking about my operational stories and interviewing other operators and syndicators on things that are going on. So yeah, check it, Ritter on Real Estate, everywhere you listen to podcasts.
Yeah. Awesome, man. Well, I really appreciate it. It's been great talking multifamily with you, and I look forward to staying in touch.
Yeah, thanks, Jonathan. I had a blast. Appreciate it.
All right. That was Kent Ritter. He's the Chief Executive Officer and founder of Hudson Investing. Again, you can find him at HudsonInvesting.com. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around so you can get a preview of who's coming up on the next episode of Zen and the Art of Real Estate Investing. Episode 276 brings Emmanuel Staphylidis, the founder and chief investment strategist at Capable Capital. This is pretty simple what they do. Acquire affordable homes in high-growth markets, structure seller finance deals, and create stable, passive income streams for investors. You're going to like this show. It's a little bit different, and it's very interesting. We'll see you next episode with Emmanuel.